me. My name is Sergio, and I represent City. And what I do is I help drive our homeownership efforts to provide opportunities to low to moderate income families and neighborhoods to achieve homeownership. So part of the reason why having these ongoing workshops is to provide the tools, the resources, the know-how on on becoming mortgage ready, right? So every one of us will have a slightly different pathway of not just getting to the finish line, right? Of not just becoming a homeowner, but sustaining homeownership in the long haul. So I appreciate the invite once again. I appreciate you joining us today. And how we typically, uh, run the workshops is we want you to be engaged, right? So definitely chime in, use the chat box feature to submit your questions. We will hold time towards the end of the workshop to answer all your questions. So if there's something that raises your interest level or you're not quite sure if I explained the concept properly or not, definitely type in your questions and Juanita and I will review them, um, you know, towards the end of the workshop. So what I have in front of you is just our overview of a home buying seminar, home buying workshop. I'm going to skip around some of the slides. I feel that some of the slides are a little more valuable in terms of information and content that we'll cover today. But like I said, uh, you always have Juanita and the Achievement Academy at your disposal. So if there's ever information that you perhaps wanted to uh, go review or have more of an intimate setting, and you're not quite sure or comfortable submitting your question in the chat box, definitely contact Juanita and get your answers, get your questions answers. So we'll start a little bit about the home buying process in general, right? And I always like to start off by a conversation around what you can buy, what you can afford. So typically, in a home buying workshop through an organization like a HUD approved housing counseling organization, the first topic that you will cover is a budgeting topic. Uh, we feel that that is key to home buying. We always relate home buying to running a marathon. You're not just going to wake up one day and start running a marathon, right? You have to build your stamina. You have to, start running, a few miles, right? Start with 2 miles, 5, 6, 10, 12, until eventually you get to that 26.2 miles, right? So having those healthy financial habits allows you to build up those positive financial habits, so that once again you begin to prepare for this process, right? But in terms of a conversation, determining how much you can afford is something you can even, it's a conversation that you can have now. And what I mean by that is essentially you can start to look and self evaluate yourself as to how you currently manage your current household expenses, right? So even before you begin speaking to a mortgage professional, perhaps a housing counselor, or even a real estate agent, these are just some of the questions that you can ask yourself in terms of, well, how much do you feel you can afford? What I mean by that is you can self analyze yourself, how you currently pay your rent, how you currently pay your bills, whether or not you feel that you are perhaps saving every month. And if you feel that perhaps there could be improvements along the way, that's where you can start to really dig deeper into your household budget to start identifying perhaps spending leaks, right? That you can work on so that you can build the momentum to homeownership. There's a lot of great programs. We'll touch on a few programs out there today, but there's programs that do provide subsidy assistance, such as down payment assistance. Um, but even if you're eligible for those types of programs, you still have to put yourself in this position, right, of being mortgage ready. So determining the cash on hand that you would need for down payment and closing costs, why that's important is because even though, once again, there are subsidies that are available for you, you still would need to have a certain amount, a certain level of contribution in this process. Calculating your monthly income and expenses, of course, that deals directly with your household budget. Estimating your monthly mortgage payment, you know, that piece is more of how comfortable you feel even now with making your housing payment, right? So if you're consistently making your monthly housing payment, which is your rent on time, on an ongoing basis, that's a great sign. If we're having to stretch that payment out a bit, or if we're having some tough decisions towards the end and the first of the month, just to make sure that we make that housing payment on time, then that's, once again, that's a great indication that you know, perhaps we should look into our household income and expenses to, once again, to better our situation before we start this process. So some of the things that are part of the cost of home buying, just like when you purchase a car, there are some fees associated with the transaction. A home is somewhat similar with that regards, is that there are fees as part of the mortgage application process. So application fees typically are loan related fees. Any bank, any lender, even small lending institutions like a mortgage broker will have fees associated as part of the overall application. There's also other fees that are not necessarily tied to the lending institution. Home inspection fees is an example of one where that's a fee that you would pay to have a professional home inspector provide you with the report on the property's structure. So that in itself, it's a separate fee than what your loan application fees will cover. An appraisal fee is one of those other fees that it's a third-party fee. It doesn't, you're not paying the lender directly per se. This is, the fee is essentially going to an appraiser, a professional third-party opinion as to the market value at this time for that specific property. So an appraisal gives you a market view of comparable properties that could be matched up to the property that you're considering in terms of market value today. So oftentimes people may assume that a few years back the property was worth X amount, or may assume that in a few years from now the property will assume a certain value. When you're buying a home, the value that's taken into account is the value today, right? Because that's the amount that you're purchasing, and that's where that appraisal would be coming in at. So although they're part of, as you can see, there's definitely other fees associated, but know that there are fees that are part of the transaction that you essentially would have to make before you even close on the purchase of your home. So that this is an example of what we mean by, you know, having that financial capability, right, of a little bit of savings, because essentially you will have to pay for some fees at the start of the process. Credit report and discount points, that's more tied into the loan application. Other third-party costs and fees, this would depend on a case by case, but know that there are other fees that are part of the transaction of home buying. And the reason why I don't want to dwell too much into this fee category is that once you, if you move forward in the home buying process, this is actually a conversation that you will have with your mortgage professional, where that person will issue a loan estimate atomizing every single fee that will be part of your transaction. So not that I want to minimize this topic, but know that for our setting today, this is more of a general overview. But one of the things I do want to dive in are into these 5 buckets, and why I feel that these 5 buckets are very important is because essentially these are the buckets that every lender will look at in order for them to determine whether or not they can provide to you a mortgage loan. So although the buckets may vary from different lender to other different lenders, essentially these are the buckets that you would want to meet. So the first bucket, we'll jump right in, right, is your assets. This includes your savings. This includes your reserves. Why this is important, once again, is because even though there are great programs out there that can help facilitate a portion of your down payment, you still may be required to have a certain amount towards your down payment. So there's great programs that offer down payment assistance. So the city of San Diego is an example of one. San Diego Housing Commission administers the city and the county of San Diego's down payment assistance program. It's a phenomenal program, but that program requires that the borrower have 3% of their own funds included as part of the down payment. So that's an example of what we mean, that although there's great programs that can help facilitate the purchase of a home, it is still a requirement from the borrower to have a contribution into the transaction. How much will vary from lender to lender, to program to program. Property appraisal. The property appraisal is a requirement, and this is one of the categories that you don't necessarily have full control, but know that the lender will require an appraisal to be done, because the lender wants to make sure that whatever they're lending on has a certain amount of value. That's where, if the, once again, depending on the transaction, every program has a specific requirement of where that value needs to come in. This is where, like I said, oftentimes you don't necessarily control this bucket, but know that it's an essential bucket for a mortgage approval, because every bank, every lender will want to look at that appraisal. So here's a quick example, right? If you're buying a property at $400,000, the appraisal would have to come in at $400,000. If the appraisal comes in below $400,000, then essentially what you're approved on is approved on the lower amount. So if the property that you're buying is $400,000, but the appraisal comes in at $390,000, then that gap in difference, it would be up to you to decide whether you negotiate that with the seller or whether you come in with a little bit of extra money down. So I know I went through that example relatively quickly, but that's just a kind of like an overview of why an appraisal is so important, because it could essentially determine the approval status of the loan that you're applying. Credit history. Now, I'll spend a little bit more time in the next slide on credit, but there's essentially two things that a lender will look in. There's two things that a lender looks at in terms of your credit, and that is the credit rating. Oftentimes we relate to this as your FICO score, and the credit content. That's what's included in your credit report that has the history, the payments, the amounts of how well you've managed your previous obligations. So once again, there's two things that stand out in a credit report. The very first thing is your credit rating, your FICO score, and the second thing is the content, right? So the lender wants to know exactly how much of an outstanding balance do you have, how much are your monthly payments, because those obligations have to be taken into consideration when you purchase a home. If you have a student loan, a car payment, and credit cards, the lender has to take into account those obligations, because even after you purchase the house, right, you still have to continue with these obligations. So that's why it's so important to understand what's part of your complete credit history. Employment and income history. This is very important because essentially this determines your capacity. How much can you afford? How much can you pay on a monthly basis based on your capacity, your income, and employment. A few years ago, believe it or not, back in the early 2000s, there were a lot of programs that had what's called stated income features. What that meant was your income was not verified. It was simply stated. What this allowed borrowers and lenders to do is, instead of verifying pay stubs and bank statements to properly allocate what your capacity was, they will simply state an income amount. So, regardless of your employment history, that was still verified, but your income wasn't verified. So it was a simple stated amount, and that's what lenders went off to determine your capacity. Now, you could see that that could play into somewhat of a unknown circumstance, right? Because if your truly income was a certain amount and you stated a different amount, right? Then whatever that monthly housing payment would be, it would be based off that stated amount, not your real amount. So essentially, you could have these conflicted uh, uh, capacity levels, but because income wasn't verified, that's the way some loans were processed. So the good thing is that today, under qualified mortgage standards, income has to be verified because lenders, banks don't want to set you up for failure, right? What they want to do is provide you with a housing payment that you can afford based on your capacity. So income, once again, very important. It's verified in a number of different ways. So depending on your circumstances, right, income is verified. If you're self-employed, there's a certain way income is verified. If you're salaried or W-2, as what we call, there's a certain way to verify your income. If your income fluctuates, there's a certain way to verify your income. So know that that's very important because, once again, lenders and banks don't want to set you up for failure. They want to make sure that whatever that housing payment is, you're able to afford that on a monthly basis. And of course, your debts, I talked a little bit about that with regards to your credit history. Debts are important because it plays a factor in your overall capacity, right? So if going back to my analogy of running a marathon, if you train properly, right, then the day of the race, you're going to have a much greater chance of not just completing the race, but perhaps having a much better time that you would have pictured, right? So debts, I relate this to, if you can manage your debts properly, right, where even now where you're not potentially in a home buying situation, manage your debts where they're under control, where they're affordable, where you're not overextending yourself, you're only going to better your chances to achieve home ownership. So credit history, here's where we always have a really good conversation on credit. Credit is a really robust conversation. There's so many ways that you can look at credit. I do want to point out that I know Juanita, through the Achievement Academy, if you have specific questions on your personal credit situations, you can definitely reach out to the Achievement Academy. But this is just like a bird's eye view on credit, right? So some of the best practices around how to better your position in terms of your credit rating revolve on timeliness of payments. So very important, because timeliness of payments, more specifically the past 24 months, will have a heavier influence or heavier weight upon your overall credit score. What do I mean by this? So I'll give you an example. Let's just say that Sergio made a late payment on his auto loan in December. Let's just say that December 2020, I simply just forgot to send in my check for my auto loan. So I send in a late car payment, right? That late payment in December will have a much heavier toll on my credit rating than me making a late payment on my car payment 4 years ago. Why is that? It's still a late payment, right? Well, timeliness of payments uh, within the past 24 months history have a heavier heavier weight than anything after 2 years. So just once again, in general terms, it is you know highly recommended that you stay on track and of your obligations, so that you don't start falling behind on your payments, because if there's a recent late payment, those recent late payments once again have a heavier burden, are looked at with you know if it's something recent, it's looked at more critical than if it's something that was over 2 years ago. New inquiries, the how new inquiries affect you is that if a lender uh, is looking at new inquiries, they are wondering why. Why is Juanita applying at Nordstrom's, at Macy's, at Target, when she's got other available credit, right? So just think about that, right? Those are the types of whys a lender will want to ask. Not that they will necessarily be a determinant factor in the decision making, but they're going to want to know why. In the home buying process, there's oftentimes um, a very strict rule that if you're applying for a mortgage, the lender and the real estate agent will say, you don't need to apply for anything else at this time, because if you're truly applying for a mortgage, you want to buy a house, then that should be your financial priority. Things that people have done that have really taken a toll in this transaction is they've applied for a car loan, they've taken out new debt, they've purchased new furniture on credit during the home buying process. So once again, going back to why a lender would ask questions is, if you're going through the home buying process and we see that there's inquiries from Toyota Financial, whatever the case may be, they're going to want to know why is this applicant running their credit to potentially purchase a car when they're buying a home. Because if they're buying a car, now they have to take that new debt into consideration and plug it into your capacity levels, and essentially that could limit you and not and provide just another hurdle for you to purchase a home. So just be wise in terms of, if home buying is the end result, is your main goal, then all your other action steps have to align with home buying. So past credit problems, this is a big depends questions, right? It just depends what it is. Anything that has to do with say garnishments, the deficiencies, certain collections, yes, they are red flags and they have to be addressed prior to a potentially you purchasing a home. Why? Is because if there's a deficiency balance, or there's a default judgment against you, essentially those creditors can go after any assets. So if you were to purchase a house, they can technically put a lien on that property. So you wouldn't want to do that. So in terms of protecting your assets, so past credit problems are looked at, really in more individualized, because the lender would want to know exactly what potential consequences those past credit problems would have. Not to downplay medical collection, and medical collection will be looked at slightly different than a default judgment on, say, an auto loan that was repossessed, right? So two distinct situations, but essentially they fall under this category of past credit problems. So those are the things that a lender will want to digest to figure out exactly what the situation is. Types of credit refers to more or less the different types of credit that you may have. It's not heavy on the weight factor in terms of credit rating, but once you have a more diverse type of credit account, such as a credit card, perhaps in the history you've had an auto loan, which is an end-term loan, and if you have a mortgage, then typically that category you would maximize, and of course elevate your credit score. Credit amount and utilization of credit kind of go hand in hand. There's a really good rule of thumb that if you have credit cards, you would want to keep the balances at or below 30% of the available limit. So to give you an example, if you have a credit card that has a limit of $1,000, you would want to keep that balance at or below $300. Why is that? It's almost like as if I'm asking you to play a game. Technically, yes, because those are some of the factors that are computing into your score. If a applicant or a borrower is shown to manage their credit on a more manageable level, right, where you're now maximizing your credit card, the balances are low, that actually looks very, very positive. If the applicant or borrower is always kind of towards the limit on their credit card, they're maximizing their credit card, they're going over the limit, then that's looked at with a slightly higher risk lens, right? You can just kind of compare the two situations, and so that's what I mean, right? So understanding how to quote unquote play the game, the credit card game, is really important, because now you could actually use it towards your advantage, right? If you have a credit card, know that keeping the balances at or below 30% of the available limit will help you maximize these categories, right? Another thing, if let's just say that right now you're slightly over that 30%. Let's just say you have them at 70% right now, because you had to do some repairs on your car, whatever the case may be. The cool thing, or the good thing I should say, is that you can actually pay down those credit cards. So once you bring down the balances to 30% or below, that's when you'll see the upswing on your FICO score. So once again, these are best practices. For more detailed information, you have the services of the Achievement Academy that can help you, guide you, if you wanted to dive a little more deeper, or if you have specific scenarios around your personal set of circumstances. So the application checklist, guys, I think we'll just skip right over. I'm gonna spend the last few minutes that we have over the total housing payment. The checklist is just when you apply for a mortgage loan, it's like the picture of it's like a financial picture of your financial life in the past 10 years, right? So there's a lot of information that's provided in terms of income, assets, identification, other documents based on particular set of circumstances. So there is a hefty checklist, and of course you would work this hand in hand with your mortgage professional to make sure that you check off every item on the checklist. So monthly housing payment, why this is so important, guys, is because this once again relates specifically to your capacity. Every program has a specific measure of capacity. How much can this person pay on a monthly basis where that payment is seen affordable? So let me just give you an example. If your monthly income was $5,000 a month, let's just walk this with me real quick. If your monthly income was $5,000 a month, and if your housing payment, what you see in front of you, if your housing payment was 50% of your monthly income, then your housing payment would be $2,500, right? That's 50% of $5,000. Would you say, and you can just kind of take a mental note, would you say that's a high amount of ratio, meaning that you're paying 50% of your monthly income towards your housing payment? or would you say that's a manageable ratio? You can kind of think about it, right? 50% of your income, 50% of your income. That's pretty high, guys. That's very high. If 50% of your income, now I know I base it on $5,000, but let's just say that my income was $3,000, $2,000, or $10,000. 50% of anything, if that's going towards your housing payment, that is seen as somewhat of a high risk. Why? Because 50% of your monthly income being tied to your housing payment is looked at as a very high housing payment. Now, relating this in terms of why I brought that example up is that every program will essentially have a certain ratio that they will approve for the borrower. So some programs can go as high as 50%. I mean, we've seen programs even higher. That's just for specific programs, specific lenders, specific borrowers. For the most part, a housing payment should fall anywhere from 38%. Just to give you a rough idea, right? 38%. What that means is for every $1,000 of income, $380 should be tied to your housing payment. So that's the basis behind every program. Every program will have a target housing payment ratio that's directly calculated from your monthly income. Now, your housing payment has layers that need to be covered. If you, as a renter now, your housing payment covers your rent. That's one layer, right? But as a homeowner, you're going to have several layers included in your housing payment. So the first layer is your principal and interest, which is specifically tied to your mortgage loan. So inside your housing payment, you're paying your mortgage, and your mortgage is divided into your principal and interest payments. So every month, a portion of your mortgage payment will go towards your principal, and a portion will go towards the interest. Usually the first 10 or 12 years, most of that payment is going towards the interest. After 10 or 12 years, then most of the payment will start going towards the principal. But the payment doesn't change, right? The payment's still your mortgage payment. So that's the first layer. The second layer is your property taxes. So owning a piece of land in a dwelling unit is home ownership, and property taxes are associated with home ownership. The assessed value is based off the first year of purchase, and whatever that amount is, a lender will simply divide it into 12 monthly payments to include a portion of that in your monthly housing payment. So that could be considered your second layer. Your first layer being the mortgage, the second layer being your property taxes. Insurance, more specifically, your homeowner's insurance. Homeowner's insurance is required by the lender to protect the structure and the assets of the home. So that could be considered your another layer in terms of what's included in your housing payment. So far we have your mortgage, which is your principal and interest. We have your property taxes, and we have your homeowner's insurance. Notice how there's a couple of other items there that I haven't covered. That's because depending on the type of property and depending on the type of mortgage that you choose, you may have additional layers included in your complete housing payment. Not to scare you guys, just to make you visualize what you have, or just to make you visualize the potential of a complete housing payment. So if your program is one that has what's called private mortgage insurance, typically programs that have private mortgage insurance are related to FHA. You may have heard of that name as a option to buy a home. Essentially, any program where the down payment of the home is less than 20%, you may have private mortgage insurance. Flood insurance, if the property is located in a designated flood zone, and FEMA is the authority behind the topography maps of how a property could be determined if it's in a flood zone. It doesn't necessarily have to be a beachfront property. Some properties in Mission Valley, of course, because after it rains, things get flooded. That's more or less where flood zone comes into play. And of course, if the property is a condominium, a townhome, or a property that's in a planned unit development, that's where if you're sharing a clubhouse with other community members, or if you're sharing a community pool, oftentimes homeowners association dues will apply. So for a townhome and condominium, it's guaranteed that you're going to have homeowners association, because the homeowner association covers the structure insurance and the common areas. If it's a planned unit development, it means that it can be a single family dwelling, but you simply have access to community shared, resources such as a clubhouse or a pool. That's where you can have additional HOAs as well. So notice how, having said that, you potentially could be in a situation where your housing payment could have multiple layers: principal, interest, taxes and insurance, private mortgage insurance, flood insurance, and even homeowner association dues, depending on the structure. So not to scare you, but that's where many different people are going to have different options. Perhaps you chose option A because that property is located in a school district that offers a special program or extracurricular activity, or like a music program or a science program that you want your kids to have access to. You could be okay with potentially living further away from work. You're okay commuting, longer drives, because you'd rather have a property that doesn't have HOA or private mortgage insurance, right? So that's where each and every one of us is going to have different points of view, different priorities. And this is where having these conversations today makes a lot more impactful in terms of going over these topics now, where we're not forced to make a decision, right? We're not buying a house tomorrow where we just have to make the decision. No, we can have these conversations now while we're still, preparing our finances, while we're still, increasing our savings, while we're still paying down debt. Because the more we talk about this, right, it's like running a marathon. We're training ourselves. We're getting financially fit, so that when we are at the right time to apply for that mortgage, right, we're going to be in a much better situation, and more options will be available. So with that, guys, I think it's time to open up the questions, Juanita, and we can start to answer some of the questions in the chat room.
Thank you, Sergio. That was wonderful. You've gotten, like always, a wonderful event with so much information. It's so hard to process it all. I hope everyone was able to pick up most of it. It's really important, all the key points you talked about. We do have one question. What do you suggest when you have an auto loan and may need to refinance it? Do you need to refinance it prior to trying to buy?
Yeah, so good question. Yeah, so if you feel that the payment is it's over extending, and if you are in a position to refinance, then yes. The lower, let me rephrase it this way. A lender will take into account the auto loan payment, not necessarily the auto loan amount. So you can have two different situations where you have the same monthly payment, $300 and $300. The auto loan on one is $6,000. The auto loan on the second option is $12,000. The lender will still take the $300 monthly payment to tie it into your debt to income ratios, which essentially determines your affordability. So yes, if you're in a position to lower that amount, fantastic. If you're not in a position to lower that amount, that's where you can, look at your complete options. If you were to sell this car Would there be a little bit of equity gain and maybe perhaps you can buy a car free and clear? Those types of conversations, right? It's better to talk about it with either a housing counselor or maybe, you paying down some, writing down some actual numbers, right? Just to see where you're at. At times, yes, an auto loan can fit the ratios to buy a house, but for the most part, if you are able to pay less interest, then yes, it's always a good option. I just when I come across questions like this, I always try to say, well, whatever one decides that it's their best option, it doesn't mean that the person next to us needs to decide that option, because that other person can have a slightly different financial picture. So that's where a one-on-one conversation with a housing counselor or with the workforce specialist at the Achievement Academy, just the more you look at your options, the better decision you're gonna make.
Hi, Sergio, talking on that same line, I'm thinking, is there, do lenders look at the length of your loan, car loan? I mean, if it's less than a year, do they still count it? When
Very
looking
good
at,
question, Juanita. Yes, so if it's 9 months or more, they do count it towards what we refer to as your debt to income ratios. That's just, once again, your capacity of taking into account your income and your obligations. So if you're going to be paying on that for over 9 months, then the lender has to take that into account. If you're going to pay off the car within 9 months or less, then they can actually remove that payment from the equation, which is nice. One thing that I want to make sure I clear up is auto leases. That's totally different. So if it's an auto lease, regardless of whether you're 9 months away from turning the car back into the dealership, the lender will still apply an auto loan payment if you have an auto lease. And the reasoning behind that is, well, if you're going to turn in the car, chances are you're going to get another car. So they have to plug in that payment for that auto lease. If it's an auto loan, 9 months or less, then no, they do not count that auto loan payment towards your debt to income ratios.
perfect. Thank you, Sergio. I don't see any other questions, and I know you need to go on to another meeting. So if anyone has any further questions, you can feel free to email me and I'll be more than happy to respond. But at this point, I want to thank you, Sergio. We are having a workshop next month for everyone that's here now. And it's going to be on student loan debt and how that affects your home buying process. So for those of you that have student loan debt and want to buy a home, this is a workshop you don't want to miss. Talk to you
Absolutely,
guys
Juanita.
soon.
Thank you
so
very much,
Juanita.
Sergio. Excellent presentation. Great seeing
Thank you.
You're
I'll see you
welcome.
guys soon.
Okay, bye-bye.
Bye.
Great job, Juanita.
Thank you, Anna, Sylvia. It's been a day.
I know. Take care.
Okay, bye.
Bye.